All right, everybody, welcome back to episode 45 of the More Doors podcast. We have an exciting guest today, someone who has, again, broken out of the W-2 handcuffs and has grown himself. What an amazing commercial real estate business. We're going to be back with our guest right after this. Okay, friends, welcome back. Episode 45 of the More Doors podcast. I got to tell you guys, I missed you last week.
I missed us too. We
apparently our guest did too.
Yeah, we're not going to name names because we have integrity, but we were here. We were ready to do a show,
and he was not.
He was not, and so
it's never good when you get the email 10 minutes after it starts,
right?
Like asking what time it starts when you know it's on their calendar.
Yeah. That was disappointing.
That was.
But hopefully they're doing something productive.
But our guest today is much better and much more timely and prompt than he was.
He's 3 minutes early.
I'm really, really excited about that.
Says a lot about a man.
It is. Exciting times here at Deep Blue Capital.
Yep.
We're making progress on our first storage JV.
Excited about it.
48 hours away from our next closing ceremony, if you will.
And you know what's interesting about the storage one is we're starting to see that momentum already. You know, we talk about the law of the first deal and how it builds momentum. No less than 3 or 4 days after we closed our first storage deal, I think we've got like 2 more opportunities already that we're sort of looking at.
Yeah.
And that's coming from the same JV partners. We're like, let's just go start to build it. And when you get past that first deal, it's like this magic thing happens where more opportunity just starts to follow.
Well, you know what they say. If you build it, you will come.
Wow.
I don't know if that's
I don't think that's the saying. Wow. Even Jesse chimed in on that one. Crazy.
Yeah. Look,
keep telling yourself that. No, Nick.
Yeah. Look, it's worked for me for 41 years.
Yes.
Yeah.
And there's proof on the way.
Exactly. Yeah. And not in November. Yeah. Look, I'm just trying to spice things up. I've had some like, the beginning of the show is sometimes fun, sometimes boring. So let's just always keep them on their toes.
That's it. Keep it spicy.
Let them know your next move.
Yeah. And look, your next move should be going to Deep Blue Capital RE. So deepbluere.com. And you're going to sign up for our newsletter. You're going to sign up right there. You can get the ebook now. Is that correct?
The ebook is live. The top
ebook
8 reasons to invest in multifamily. I'm not saying that there was somebody else that wrote the top 7 and I just put an extra one on there, but just check out the book.
The next one will be the top 1 reason why you should
8-minute abs.
Yes.
7-minute abs.
So go to deepbluere.com and that way you can sign up and get that ebook. It is free. Do it before we start charging for it because it's flying off the download shelves.
It absolutely is.
Yeah.
We're running out of download space.
Exactly. And then all you need to do is look, you want a podcast list like this, go to torstudios.com and Jesse will hook you up. He's got these perfect new microphones set up. It's got a pop filter built in.
Pippity pop, pop, pop.
Exactly. So torstudios.com, you can get a great looking setup just like this, and he'll take great care of you. So, and then look, you got to leave us reviews, man. Please go leave us reviews.
Smash the subscribe button and leave a review.
Yep. Go do that. Go to our YouTube channel, subscribe there. You're going to start seeing a ton of content being released there every day, I believe.
Yeah. Every day.
So go to just go to Deep Blue RE. Is it the More Doors?
It's More Doors.
No. The URL is Deep Blue RE.
Okay.
Yeah.
It's on YouTube. Deep Blue RE on YouTube.
Good thing somebody's paying attention to that.
Changed it.
I just always search for More Doors podcast.
So that's what I do, and that's why I was a little confused because when I go search for it, I just search for the More Doors and it pops up.
Yeah.
That's because we're famous.
Okay.
Yeah.
Nice. So it's
SEO right there.
The SEO is connecting the dots.
So at Deep Blue RE. Yeah.
Nice.
Mm-hmm.
At Deep Blue RE on YouTube. Go check out what's being released there every single day.
Yes.
And,
we've also been silly busy on LinkedIn lately.
Yes.
Yeah.
Where we could just a lot of great nuggets coming out.
Great nuggets.
Even more.
We'll be looking for more live webinars on LinkedIn, things like that. We're bringing a whole lot more content to educate our target avatar, which I'm very excited about.
As are we.
Absolutely.
Speaking of excited.
Yes, sir. I'm very excited to welcome Mr. Geoff Stuhr to the podcast. Welcome, brother. We appreciate you taking the time. Let's bring him up. How are you?
Hey guys, I'm doing great. I gotta tell you, the energy is pretty good. People usually tell me like, "Hey, you've got serious, like insane high level of energy. And I think I just met my match here. You guys are, and it's fun. I could already tell it's going to be fun. So this is going to be awesome.
Thank you, man. I appreciate it. It's really, it's a blessing to have our best friends that we get to do the podcast with, because really, even if the cameras weren't on, this is just how we talk to one another.
Yeah, true story.
So it makes it a lot of fun, man.
It's probably dialed down a little.
Yeah, a little bit.
Yeah.
Good thing you don't see the emoji exchange on the show.
Yeah.
I believe it. I believe it.
So Geoff, tell us, and Brian usually does this part, but Geoff, give us the 30,000 foot overview of who you are, your Smart Asset Capital. How'd you get started? Give us all the gold right up front.
Yeah. You want me to start from the beginning, or do you want me to just tell you kind of what I'm doing now, and then we work backwards?
Well, why don't you start with what you're up to lately, and then we can backtrack a little bit. We don't need to go back as far as diapers or anything.
Yeah. No worries. I just okay. Yeah, I wasn't sure career wise, but so I guess what I'm up to now. So I was a W-2 employee for the last since I left college, so 12 years. While I was building a real estate business on the side for pretty much 10 years or a little bit more. I'd always been in sales. And right now we've scaled our business from doing a lot of different JVs, as I heard you guys talking about, to doing multifamily syndications, to spreading into different asset classes. And we just launched our first fund and are doing our first capital call for that fund. We're raising $20 million to buy Class B industrial real estate primarily throughout southeastern Wisconsin, but we do have some latitude to go around the Midwest for that as well. So it's been extremely, extremely busy, but that's what's going on right now. I lead capital raising for our team and oversee a lot of the other real estate related stuff as well. There's 3 partners on our team too, so we're like 2 peas in a pod.
Yeah, nice. Excellent, man. So take us through a little bit. We talked a little bit before the show just about kind of all the different verticals you guys have in your business. It sounds like you guys started with the real estate brokerage side. Is that correct?
Yeah. So there's 3 partners. There's myself, there's Adam, and there's Brock. Adam he's the OG, right? I gotta pay homage to him. He's the one. He and I started at our first job together out of college. He was a year older than me and kind of mentored me in this sales job. And then we were driving around doing cold calls or something, and he was negotiating. I think it was his first real estate deal at that time. I think he was like 23 and I was 22, and and I was like, man, I wasn't even really thinking about that. I was just trying to be great at sales and try to get to a point where I was making a lot of money. And then, fast forward, I saw him buy a ton of real estate. He actually started, I think he bought like 30 units. And so he would be a great guy to have on the podcast too. But,
Sure.
He bought a bunch of units. He was struggling with property management companies, and then decided to start. He had a lot of investor friends of his saying, hey, I'd be interested in getting into real estate. So he got a real estate license, and then he started a management company, and he really built the brokerage up and the management company up, for the last 10 years. Now the management company does just right around 4,000 units, third party, as well as, the stuff that we own. So there's a mix there. And then he, and then also the commercial stuff that we have. But about 5 years ago, I came to him and said, hey, we should really consider this private equity syndication route and look into this. I walked into his office with a stack of like 5 books, all the big ones that I'm sure you guys have read. And basically just said, hey, we should consider this route. And then I joined an educational mastermind group. We got pretty ingrained in that community. I still catch up with those guys quite a bit. I'm going to be going to one of their events in August. And from there, we did a JV for a 34 unit apartment building. And then we did an 89 unit apartment building, and then just kind of scaled it up and up from there, for the past 5 years. And, now we got to the point where we're launching a fund.
Oh, fantastic, man. So that's the journey, right?
Absolutely.
Start, you build the verticals, and then you scale up on every single deal. Did you find any what was the learning curve from doing your first 34 unit deal, which I'm sure you had to smash a lot of limiting beliefs just to get that first deal done, and then you level up every time from there. What is the mindset behind the journey of getting bigger on every deal? Take us through kind of what that feels like.
Well, I'll even take it back to when I was buying duplexes. I mean, and I was self-managing those. I think I had 8 units that I was managing, and I was working a full-time W-2 tech sales job, flying around the country and still trying to manage these properties. And I remember I got, it's at every level. There's something happens, or there's some sort of inflection point where you're like, oh my God, I don't even know if this is for me. Like, this sucks. Why would anyone want to do this? And I can point to, scenarios at each phase, I guess, over the last 10 years where, you want to throw in the towel, you want to give it up, but you kind of keep that bigger goal in mind and at the forefront. And from there, you just got to make a decision. Am I going to roll with it and push through? And I've always found that by pushing through, it doesn't last forever. Things get easier. Things work out. Sometimes you get a little bit lucky. Sometimes you get unlucky. But as long as you're hitting more, base hits than you are sort of striking out. I don't know if that's a great analogy, but as long as you're getting more wins than losses and looking at the greater sort of portfolio as a whole and growing it, I think, it helps you as long as you can get some wins in there while you're going through some tough times. It can help propel you forward. But I'd be lying if I didn't say that there wasn't many times over the last decade that I've thought, man, I don't know if this is for me. And I'm so grateful and thankful that, that I did, sort of push through and stick with it. And it's something that I'm going to carry with me. Hopefully I'm doing this for the next 50 years. And I'm sure it's going to continue in that sort of same trend where it's not a straight line up, right? There's a lot of up and downs along the way.
Yeah. So Geoff, one of the things that I'd love to, if you could dig in on, is the transition from not just a W-2, but a technology W-2, right? Technology sales W-2. So we've had, I don't know, 3 or 4 other guests on the show that most of them came from sales, one from more the consulting side, that had a very successful sales career and decided to transition into one form of commercial real estate or another. So what was really that catalyst for you to say, this is something I'm going to do after an 8 or 10 year journey with one of the biggest software companies in the world, and to say, you know what, it's time for me to leave that behind and go do something else that's completely unrelated?
Yeah. Yeah. Well, so I had always been doing real estate, on the side, right? Building up a portfolio. So it wasn't completely something that was like I was jumping in to start something brand new. And the day that I was done working at SAP, it was, I was just as busy as I was before I left SAP, and if not more, because then you kind of find out like, it's totally all on me. I don't have a whole team around me. We do have a team here, but it was just, it's a sort of a heightened level of accountability to the man in the mirror, to yourself, right? And so it's something that I'm still working on, right? I got up today at not to like, sound like I'm just this crazy workaholic, but today I got up to take a pee at 3:30 in the morning, and I just decided I'm going to stay up and work. And it doesn't always work like that. I'll be honest. I'm not like that all the time, just completely dialed in, right? I had a Polish friend's wedding this past weekend, and I did not get much work done at all. But so transition wise, right? So I had been working at SAP for a long time. I think it's the greatest software company in the world. I love those guys. I'm beyond grateful for the opportunity there. And I met so many good people, and it really did feel like a family. So that part made it even harder, because as I was letting them know that I was going to make this transition, and I had been talking about it for years, but I kept a high level of performance up within my W-2 job, and I think that kind of helped me hang around there. And then a couple years ago I got promoted, and then this year I was looking at an opportunity to potentially get promoted, but I just knew that the bigger dream and the bigger goal was to go all in on this real estate dream. And I knew if I didn't do it now, it would just only get harder down the road. And so I figured, timing's never completely right, but I figured this was the right time for us, given just the point where our company's at, the point financially where I'm at personally, and just the amount of deal flow that we're starting to see. It really felt like the stars were aligning. And so, I view real estate really as a passion. So just as you guys like bullshitting together, like I sit and talk real estate with anybody that wants to listen. And I love getting involved in conversations, whether it's with people that are considering their first single family rental, or, someone that has way more, assets under management than me. I enjoy both of those conversations. So that's another thing too. It wasn't like I was starting a brand new company and like, I'm not really sure if I like this or not. I knew I loved real estate. And so, with SAP, I was basically, a high level enterprise sales rep. And I did a number of different verticals, a number of different things as a specialist, as a generalist, overseeing, a team in half the country. I had the whole Western half of the country when I left for one group at SAP. And, I had learned so much about selling and about, setting a goal, working towards that goal, negotiating, all while we were doing a lot of real estate deals on the side, and building a business on the side as well. And, so I knew that I could take a lot of the skills that I had learned at SAP in relation to, sales and translate that stuff over to our private equity real estate business, which is where I spend the bulk of my time, primarily capital raising and investor relations for our business. I get involved in pretty much everything else as well. I try not to do as much of the back end admin stuff, but I get pulled into some of that too, like legal calls. You set up a fund, the legal paperwork versus
that's Nick's favorite.
Yeah, right. Yeah. So it's so it was a smooth transition. It was hard because there was a lot of people that I liked working with. There was a lot of you do a lot of customers, partners, your colleagues. They become friends over the years. And I try to always tell them, like, SAP's big conference, they do Sapphire. It was last week. And then, or maybe the week before, I don't know. I can't remember. And then there's a big, field kickoff, SKO meeting. And I keep telling the guys that I'm going to make a surprise appearance there because I really thoroughly enjoy a lot of those people, and those are fun times. But I just knew that where my vision has been, and I've been, and I think I alluded to this earlier when I talked about kind of going through tough times, and I'm happy to talk about any specific examples that you might want to hear or might think would be helpful. I'm an open book, but I think one of the things that's really helped me so far, and I've got a really, really long way to go. I don't think I've made it in any sense of the phrase, but having that vision and having a strong vision, writing down your goals, and seeing it as sort of a North Star, I kind of realized that it's going to be a lot harder for me to get to where I want to get to if I continue down, the W-2 track versus if I, go off on my own, jump off the cliff. I don't have a regular paycheck. I do have income from real estate. So it's not like it's going from making a certain amount to making zero, but I just knew that if I could spend those 50, 60 hours of work per week on, and then even just the subconscious time in my mind thinking about all this stuff, and I could spend that all on our business, that I could take things a lot further than if I'm kind of doing both and juggling.
Mm-hmm. I like it. So one last question here on this topic. So think about as you announced your transition out of SAP formally, right? I'm sure there were a lot of people that were, congratulating you and asking questions about what you're doing next. But if you think about those conversations, how many of those conversations were inclusive of things like, oh man, I always wanted to get involved in real estate, or how did you do it, or why real estate, and how did I get started?
Yeah. Yeah, my phone was blowing up. I'll just say that. Anytime you spend almost a decade at a company, you get a lot of friends, and salespeople love to talk to each other. There's been so many people that have reached out to me. I would say I wasn't very quiet about it the last year or two that I am in real estate, and a lot of times, even in conversations with clients, I would try to use it to my benefit. I think the way that I started to look at it is, I'm a business person. I work for the SAP company, the team, and that's my job. But I have a lot of business endeavors on the side as well, and looking at investments and return on investments, and from the lens of a business person, kind of helped make me a better salesperson, because I could literally sit in in a CIO or CFO's shoes and ask them about, what's important in their business. What are they trying to accomplish? What do they think that investing in this sort of technology will help them achieve? And I would try to empathize with them. And I think it started to go a long way. But a lot of people reached out to me and said, yeah, man, I how do I get started? Right. Should I invest with you? Should I buy a duplex? Should I buy, what can I do? A lot of people in tech sales are, sort of cash rich, asset poor. And, and that was, that's not necessarily me, there's been a lot of times that I've had a decent amount of cash, but I always seem to, pump it into real estate deals. And that's helped over the long-term build up, income. And I wouldn't say it's passive income, right? It's like, something that we actively manage, and there's a lot of shit that always comes up. So it's definitely not passive, but I tell people all the time, the people that were calling me, I tell everyone you should get some sort of exposure to real estate. It's a phenomenal way to build wealth. It's changed my life. And, whether it's going out and buying, 3 or 4 single family rentals, or small, 2 to 4 unit, multifamily deals, and just having those as just a part of your portfolio, or whether it's investing with a guy like me at Smart Asset Capital, or you guys at Deep Blue, or many other, sponsors that do this type of stuff. It would behoove somebody that earns a great living and has additional cash to not really get invested in real estate. And that could even be Fundrise or a REIT, but there's, and we could talk about the differences of all that stuff, and why you might want to do whatever one. But there was a ton of people that have reached out and are still reaching out, and I'm so thankful to have such a good group of buddies there that are interested in what I've got going on in the next phase of my career.
Good.
So Geoff, as you transitioned, right, and we should probably ask this even more with our guests coming on, is like, what when you transition out of sales, right? The salespeople, their goal is to make as much money as possible, and then hopefully invest it, or just go out and buy bottle service every weekend, whatever that is.
Yeah.
And but
I've done that a time or two.
Yeah, right. As do most young successful salespeople. But as you were making that journey over into full-time real estate investment, what was your long-term goals, financially, personally, and then how is that aligned with Smart Asset Capital, and what is their goals?
Yeah. So we don't have a number from an assets under management perspective. We do think a lot about goal setting and quarterly objectives and different milestones that we want to reach, but we don't have a specific number. Just like I don't really have a number like, oh, I want to be worth 100 million or something. But I knew I did some math, back of the napkin math, and I kind of figured out if I stay at this level in sales. And I didn't know if I wanted to go completely up the ladder and become, a chief revenue officer or something like that. I didn't really feel like that was something that I wanted to do. But I just felt like there was a much better path. Real estate has so much scale to it. So from a goals perspective, I am very, very, very focused on the amount of equity that I have in income producing assets. Because now I can look at it and look back, and I can look across a portfolio of deals and see how that increases my income. And I can see how we actively can, add value and force appreciation into these properties. And then how, the equity that I have in those deals can really create a huge lump sum once we go to exit those deals. So, rather than, me trying to be just super hungry for commissions, it sort of transitioned to me being very, very hungry for getting more equity in these income producing assets and making sure they're a great deal first and foremost. But it was a little bit of a mindset switch of equity, like cash in hand, that is, taxed heavily, versus, equity and income producing real estate that is taxed in a much different way.
Yeah, and I mean that's one of the biggest kind of mind shifts that I would say that your target avatar in tech professionals who are usually kind of cash rich, asset poor, really have to start to wrap their heads around when you really start securing your financial future, I would say. And to that end, your transition out of tech sales into your role now is very natural, right? Being a capital raiser is sales in and of itself. You're presenting an opportunity, and you're aligning with someone's best interest, whether you're selling them a software or helping them secure your financial future. So as you made that transition to where you are now, take us through, what does the day-to-day look like for someone whose sole purpose in the business is really focusing on raising capital? What does it look like in general? And more specifically, what does it look like in this environment right now?
Yeah. In general, it's the same. I say it a lot, it's similar to what I was doing at SAP, where my calendar is back to back to back meetings. And whether those meetings are with a client or an investor, or they're getting ready for a meeting with a client or an investor, or, just working on a deal. I do a lot of work, in the background on deals. Like, I'm not our lead underwriter, but we have a deal committee. We have a weekly board meeting. We have, leasing meetings. We have CapEx meetings, debt meetings that I sit in on a lot of those as well. So I'm in on all that stuff and overseeing everything as well. And then on the capital raising side, my goal that I set for myself is just, in sales, you try to get, as many new prospect introductions as you can on the calendar, right? You want to fill your pipeline with qualified clients, or in this case, qualified investors. So I'm constantly reaching out to potential referral sources. I'm constantly still posting on LinkedIn, we have a podcast on YouTube as well. I'm trying to find ways to get great content there. I've got a Rolodex of 1,000 or so investors that that personally know me, that we've kind of built that list over the past 5 or 6 years. And, so I just kind of go through, we use HubSpot for CRM. I try to get meetings set up with them, whether that's lunch, whether it's a call, whether it's a Zoom, meeting like this, or whether I'm, taking them out somewhere. I was out in New York meeting with investors, like a month ago or so. So I'm doing some road shows around the country, and then just trying to set up a lot of different meetings. We're trying to set up little happy hours and different things like that. Very, very, very similar to what I was doing at SAP. And, in this climate, right, it's tough to raise capital right now. I think there's still, and it just depends too. So this is another thing that translates back to my experience at SAP. So at SAP, I worked with some of the biggest companies in the world as SAP customers, and being their key account executive, right? And I look at them as kind of like if you were to translate that over to real estate and capital raising, that would be like institutional capital and like the family offices, right? And then I look at, I spent time in our mid-market business, which, would be a lot more highly transactional deals. But, so we're still going after retail investors. Of course, that's probably the bulk majority of who's going to be invested in this fund. But, you've got sort of classes of retail investors. Our fund is 506C, so you have to be accredited, but you can have somebody that makes 300 grand a year and they really don't know anything about real estate. And so sometimes you've got to spend time getting them up the learning curve of how real estate can help them, help add to their portfolio. And then you've got guys that are making $1 million a year. They know us, they like us, they trust us. They've invested with us before. They'll refer some of their friends and colleagues. They're not family office capital or institutional capital, but they have a decent check size that they can write. Like $500,000 or something like that, right? And so you got to spend time, and it's not like A, B, and C accounts like at SAP. That's how we categorize a lot of things. It's they're all important, they're all equally important, but it's spending time trying to target groups within each of those categories that maybe I've been referred to, or we're part of the same group, or something along those lines. And then making a list of the people there that I want to talk to, and then working that list. It's pretty similar to what I was doing at SAP.
Yeah, love that, man, and I appreciate the deep dive too. So to be really, really kind of strategic with it, what is your personal goal for new investor conversations per week that you set for yourself?
Yeah, I want to have 20 new investor conversations a week, and the hard part is I I think about it, and I used to bitch about goals that were set for us at companies, but I found out that when I set goals for myself, they're even harder. So I think I kind of wish that I miss the old quotas that I used to get that I thought were too high. But 20 investor conversations a week, right? Then you've got to work them through the funnel. You got to figure out where they are along their investment journey. You hit the nail on the head when you're talking about aligning interests, right? You've got to make sure that they're that the solution that you're offering does fit what they need. And if it doesn't, no worries at all. You might want to put them back into some sort of nurturing phase to continue to build a relationship with them and get to know them. And maybe like I said, I hope I do this for the next 50 years. So 5 years down the road, it could be a great fit. But right now it might not be, versus someone that's like, hey, I have capital to deploy right now. That's the nice thing when you do get to those bigger capital groups, institutional money and family offices, they have investment mandates, right? Where they have to deploy that capital. And they're like, Geoff, I want to write you the full check right now. Because when a fund works, you kind of call in capital on a pro rata basis. So like if they commit $1 million, but you already have 5 million committed, and you only need, 3 million or 2 million for the first capital call, you're not going to call their full $1 million. So, but then it's funny with those groups, they're like, I want to give you this money right now because I need to get it to work, versus other like, smaller investors, more retail investors, especially ones that haven't done this type of investment before. They're much more, just being educated, learning, trying to understand, how it fits in. They want to, and that's why having an ebook like the one that you guys wrote would be great. I'm writing one right now, and we try to do a lot of podcasts on like content that I think would be good for them so that we can repurpose them. Sometimes I'm getting on calls with their attorneys, their accountants, and just walking them through the process of how that looks. And like I said, again, I'm happy to help people, whether if someone sees me on this podcast or reaches out on LinkedIn, even if they're not considering investing with us, but they want to talk through buying a single family rental or a duplex, I'd gladly be able to talk through that with them too. And I'm just trying to continually, and I consider that an investor conversation. So, that could be one of 20. And to be clear, I haven't hit 20 yet since I've been doing it, but that I try to set stretch goals, right? Our goal is to raise $20 million by the end of this year. And I've got to look at, there's a certain amount of checks that we're, anticipating are going to be between 100 and 300,000, a certain amount that'll be between 300 and $1 million. And then hopefully a couple bigger slugs that'll be, a couple million to maybe 5 million, that'll make that whole thing up. And it is tough to raise capital right now. I don't think I mentioned that. Obviously, right now, as compared to a couple years ago when interest rates were so low, their risk-free rate of return is something that always gets brought up, right? And so you're fighting against bonds, you're fighting against other investments that are more liquid, right? And so you've got to be able to overcome some of those fears that are very rational, and it makes a lot of sense. So we don't want to take people's last $100,000, right? That's not what we're trying to do. We're really trying to add more investors to the funnel that are at that level where they have a lot of cash sitting around, and they either don't have that much exposure to real estate, or they may have an investment mandate to get more exposure into real estate, specifically in industrial real estate. If they understand that, that's a plus. But it's a lot of educating and trying to align interests and get people bought in.
Geoff, walk us down the path of, the syndication process, and then why the fund. Give me the differences of that. Why would someone want to? Are you guys now going straight fund, or are you still going to go down also doing some syndications as well?
It's not to say we wouldn't do some syndications. I do think we're going to go the fund route for the most part. So syndication is pooling. I know you guys know this, right? You're doing it, but for listeners, right? It's pooling together a group of of funds to go buy a property or do a project. You can syndicate anything, but that was the reason that we did the fund is because we stumbled into industrial real estate like 3 or 4 years ago, and we just kind of naturally realized that we're in a great market for it, and we can find deals easier and sort of manufacture deals easier within industrial than we could in multifamily. And so what's the issue with industrial that I see as I look across our portfolio is there's a lack of diversification. These industrial buildings might have one tenant, or they might have 2 or 3 or 7, right? So inherently there's a vacancy risk there that you have a lot less of in multifamily or self-storage. And so we came together as a team. We thought, all right, well, if we had 15 of these buildings, and one of them goes vacant, it's a lot less risky than if we just do deal by deal syndications. So the process for syndication is, you get a deal under contract, and then you go out to your investors and you present the deal to them, and then you basically let them know, like, hey, there's a flag in the ground planted at this day, and we're going to be closing the deal a week later or whatever, and we're going to need all the money wired by then, and so are you in or not, right? And with a fund, it's different. We're raising money over the course of the next year. Hopefully over the next 6 months we'll be fully funded, fully committed. But so you've got less of a like a date that they have to invest by, right? So you've got more selling work up front, because they could say, well, Geoff, why would I get in now? I can just get in August, right? And that's why you're trying to find the groups that have to put money to work, or that really want to put money to work, that believe in your thesis, and then are willing to commit now versus later. And there's little incentives that you can do to incentivize them to getting in earlier versus later in the fund. And to your other question, would we ever do a syndication? Of course. I view all this stuff, whether it's a joint venture, whether it's me just flipping a house on my own. My dad bought some land on a lake. I might help him build a house. All this stuff within real estate, I look at as like kind of tools in our tool belt. I think our business is going to be growing this fund and trying to get to the point where we're institutional level, and trying to do that in a fairly short amount of time in the next 5 years or so, right? 10 years. But that's not to say that I wouldn't do JVs or syndications or go buy other deals, in other strategies. as well, like kind of on the side. I hope that answers your question.
Yeah. So clearly, Geoff, you're familiar with, various types of real estate. You mentioned flips. We've talked about multi. You mentioned storage. Of all the things that you could do and your group could do, why industrial, especially with the vacancy risk that you mentioned before?
Yeah, that's a great question. So, like I said, I think you've got to kind of take what the market gives you. I was struggling to find good multifamily deals here that made sense, and the southeastern Wisconsin, the market dynamics just seemed to make a lot of sense. It makes sense for multifamily too, but like I said before, we were able to kind of manufacture great deals, using things like a sale leaseback, basically buying. So what happens a lot of time is a private equity company will come in and buy this manufacturing business or buy whatever this, warehousing or distribution business or whatever, but they don't want to have the real estate on the books. So we could come in and buy these deals at like a 10 cap and have them pay us rent for the first, 2 years and basically have 2 years to lease it up. Now the risk is that we're not going to, find anyone in 2 years. But when you look at the vacancy statistics in our market, you look at the supply statistics in our market. I'm in Waukesha, Wisconsin right now at our headquarters, and that's in between Milwaukee and Madison, kind of closer to Milwaukee. But it's been numerous reports have showed it as the least vacant submarket in the country, and so that kind of stood out to us. Like I said, we stumbled upon an industrial deal, and we're like, yeah, let's do it. That was 4 years ago or so, and we did that. We thought, and that was a smaller flex industrial deal, and we found that it was, actually really easy to lease it up and get. And the other thing is too, a lot of times, it's the same as multifamily, right? Like you've got to come in, you've got to renovate the property. We do, power, air, parking. We try to renovate all that stuff, dress it up, make it nicer. And then, basically getting those rents to market. So mark to market, same exact play that you would do in multifamily. I think it was a little bit overlooked, at least in southeastern Wisconsin, right? The value add multifamily play was what so many people were doing. And I have a lot of buddies that do this across the country. And so the deals were harder to find. And so, but we still found a lot of deals, and we have a lot of deal flow now where we feel like we can add that value, and we know enough about leasing in this area that we feel strongly that that this asset class, the more we looked into it, the more we felt like this asset class was going to continue to do well. There's a number of things going on at a macro level, whether that's like e-commerce. There's a e-commerce, last mile delivery, nearshoring, onshoring, reshoring, which is, the CHIPS Act, which is bringing a lot of, and just the supply chain disruptions during COVID and the pandemic, really taught a lot of companies that they would be better suited having their product made closer to their end customer. And the U.S. consumer is the biggest consumer in the world. And so you see a lot of that. You see a lot of people, like in our market, moving their companies or their operations across the border of Illinois into Wisconsin, because it's just a cheaper cost of labor, cheaper for their employees to live. And so all those dynamics together just kind of made sense for us. And I tell everybody, whatever market you're in, there's going to be a way to make money in real estate, and you've got to figure out like kind of what that is. And a lot of times it's trial and error. I've certainly made a lot of errors, but we just sort of decided we had to pick one, at least one, and go down that path. Now that being said too, even in the fund, we left some latitude in our legal docs. One of the strategic advisors on our fund was a part of a group that managed. They went public on Wall Street, and they managed $50 billion or so in assets under management. He was the controller, And so they did a ton of due diligence on us. They made a big investment with us and then came on board as strategic advisors. And, they said there's some back and forth internally, I think there, but a lot of investors like it when you have a very, very narrow single focus on one asset class. Like I do only self-storage, and I know everything about self-storage, and I do self-storage in tertiary markets, and I only do a certain size, right? So like our bread and butter is class B industrial real estate, $2 to $10 million deals, which is like 20,000 to 150,000 square feet. There's other parameters that we have around that, but we left some latitude even in the first fund to potentially buy multifamily or other deals if we thought they were a screaming deal. And that's only because we do have the ability to manage those and feel confident that we can do that. But industrial is kind of the main thing we're looking for right now.
Do you find, and I appreciate, the deep dive, and I guess my head is going just really quick on the industrial side. You mentioned, vacancy rates and things like that, but I also kind of would think that the dearth of supply is probably also a positive offset for declining rental rates. So, for example, here in North Texas, there's an abundance of Class A multifamily. But that could be a problem if you own thousands of units because Class A rents are moving backwards right now, whereas there are only so many specific uses for industrial property. So if you can get past the diversification aspect where you get 15 different assets, I would imagine that your rental rates are probably pretty solid because there's a dearth of supply, and so they can't just go rent a very similar building for cheaper down the road.
You're spot on. So and it's actually one of the slides in our deck. If you look at the stats for the different sizes of industrial buildings and the different markets, so like a tier 1 market versus a tier 2 market, and then like, let's say a 500,000 plus square foot building, 250 to 500, 100 to 250, 50 to 100, and then under 50,000 square feet. If you look at what is being built, and this is nationally, but it's also very much in our market, but I'm sure it's in Texas as well. Most of the industrial building and the supply that's come on the market is for these major like Amazon warehouses that you see are huge, right? So they're really not building a whole lot of 50,000 square foot industrial buildings. So you're spot on. Rental rates have actually gone up for that size of a property. And the same thing goes for just tier 2 markets from a vacancy perspective. So we looked at that and we thought, okay, we're in a tier 2 market, just north of Chicago. There's businesses moving their operations up towards, across the border. And, there's a lot of Class B industrial buildings that are a little bit older. They're a little bit, they're outdated if you compare them to what's being built today. But there's still a lot of businesses that have use for that stuff. And the other thing is, as robotics and innovation, picks up, even further, we're finding that innovation is getting passed on to the landlord in the sense of their buildings, while they're not being built in a way where there's 30-foot clear heights and there's overhead doors everywhere. The more that these businesses adopt innovation within their own business, like such as robotics, the more that they can get like a productive use out of a space that's a little bit outdated. So that was also another benefit that we saw for that.
Oh, man, is this all triple net stuff that you're doing?
Yeah, a lot of times we're buying it gross leases, and then the goal is to flip them to triple net. God bless the triple net lease. When I figured out what a triple net lease was, I was like, oh my goodness, it insulates you from inflation. It's just a much more simple, clean.
You're basically offloading the taxes, insurance, and repairs and maintenance component of multifamily
and utilities.
Yeah,
and utilities.
Yeah. Love
that.
Can
we do some triple net apartments?
I was literally thinking the same thing. I was like, is that something?
Can we try that?
We'd probably be the first
tomorrow.
Yeah, exactly.
Yeah. So as taxes go up or insurance goes up, right, that cost all gets passed on to the tenant.
That's amazing. I love that just by itself.
100%, man. Well, Geoff, we want to be respectful of your time, man. We certainly appreciate you sharing your background, your story. I'd love to have you back on and dive even deeper, man. I feel like we just kind of scratched the surface of what you guys are doing. You have an amazing journey. It parallels a lot of ours in a way, and it feels like we've dovetailed really nicely with a lot of things that we have in common. So I'd certainly love to have you back on, man. But where can people find you? Where can they find Smart Assets? Where can they connect with you?
Yeah, a couple things. I wanted to say this too. I wanted to just mention I am definitely not, I'm still bullish on multifamily and the dynamics within multifamily. And I still own a decent portfolio of multifamily, over 100 units. And I like self-storage too. So those are two great asset classes. I didn't want to take anything away from that.
Yeah. No, never.
Secondly, I think you guys are great. I'd love to have you on our podcast as well, and I'd be happy to come back onto yours in the future as we get rolling with this fund.
Let's do it, man. Absolutely. Shoot us an email. We come on anytime, man. That'd be a blast.
Awesome. Okay, we'll get that set up, and then so where can people find me? I think the best way you can find me is on LinkedIn. You just look up my name. It's a funky name, GeoffStuhr. Smart Asset Capital's on LinkedIn. We have Smart Asset Realty as well. And then we've got a YouTube channel. The channel's called Winning Wealth. We don't just talk about real estate, but we talk a lot about real estate. But it's all different types of business ideas and things like that. We have a lot of guests on, but I would say the best place to find me is LinkedIn.
Love that, man. And last thing, we're going to start doing this to every one of our guests on the air. We're so fortunate to do this podcast. We're so fortunate to be able to connect with some of the best minds in real estate, and we're committed to getting everybody together now. So we're going to start a biannual mastermind now, and I'm asking people on the air so that we can have recorded commitments. We're doing Deep Blue summer camp. And then we're doing Deep Blue Winter Formal. We're going to get a mastermind going with all of our podcast guests, bringing together in the summer for some fishing and some golf and some business. And then we'll do the same thing in the winter. So I'm just going to assume that you're a yes. We're going to get details out to you for our next one.
Hey, I wouldn't miss it, guys. I'm all about it. I'm all about that. I'm all about networking. And you said golf. So you had me there.
There you go.
Can we do like a Santa trot? What is it? Santa bar crawl?
There you go.
Yeah, do that. That's definitely that's in the agenda.
Exactly.
I'm in for that too.
Love it, brother. Man, we really appreciate the time. So go connect with Geoff on LinkedIn. Check out Smart Asset Capital. Catch us on their podcast, and we'd love to have you back again, brother.
I appreciate you guys so much. Thank you.
Absolutely.
Good luck, Geoff.
All right.
Yep. Thank you very much.
re.com, tourstudios.com. Episode 45, guys. We'll see you next time.